why do you think now might be the time to be, if not taking money off the table, at least a little bit cautious?
Yeah, that's right. I think cautious is the right word. I think being selective is important here. A couple of signals that we look to. The first is that the S&P is 14% above its pre-COVID highs. That shows we've come a long way. We still have some work to do on COVID recovery, but the market's gotten pretty far ahead of that. We also see some signals in things like lower price stocks doing very well since the vaccine news, non-earners, lower quality companies doing well. So all of that points to the fact that we've come a long way really fast since early November. It's time to maybe take a pause, revisit allocations, and be careful and selective in terms of what you own.
And what is the biggest risk right now, do you think, Robert?
Well, I think investors rightly have their eye on inflation. You know, one of the things supporting valuation here is low interest rates. With the 10-year around 1% and dividend yields more like 1.5%, stocks look pretty compelling. But investors really rightfully have their eye on inflation as a risk factor that could emerge. It's possible that we get a brief inflation scare somewhere along the year. You've got tips at 2%, Fed's expectations are 2%, consensus is 2%. So if we come in with an inflation print above 2%, that's going to catch some attention and might spook investors briefly. However, we think this economy's got a lot of capacity in it. It's shown itself to be very elastic on the supply side, able to expand and adjust and unlock productivity. So we don't think any inflation concerns are likely to be long-lived.
You know, we got a story on CNBC.com. Legendary investor Jeremy Grantham thinks that the markets have gotten ahead of themselves and that investors need to be cautious. What do you think? Have we gotten ahead of ourselves? Are valuations too optimistically pricing in this return to normal and boom out of the pandemic in the second half of the year?
Well, I think there are pockets of that. But overall, when we look at valuation and you think about a calendar year, we've looked back over the past 60 years. A typical year sees PE up or down by about 3 points. That would be a 10 to 15% move from here. We think that's pretty normal. I don't think valuation is going to be a tailwind, but I think it's well supported here. And so I think when you look ahead, that you have to find those areas of opportunity, and we're certainly seeing some of those. There are pockets of the market where higher percentages of stocks are still pretty far away from their 52-week high, and those are probably the places you want to be looking for opportunity.
The hottest place in the entire market has been small caps. They're up 30% in the last couple of months. Are you a believer? Are you a buyer, Robert, of the small caps?
I do think there's still opportunity in small cap. Have to be careful. A large percentage of the small cap index is companies that aren't making money, that are non-earners. So you have to be careful in terms of sorting through it. But there's still a lot of opportunity there. That's one of the index benchmarks that has a very high percentage of companies that are still very far away from 52-week highs. And so there is still room to go in that particular area, so long as you're careful and selective.
Shepard Smith here. Thanks for watching CNBC on YouTube.